21 Lehman systemic risk indicators that look at equity and credit point to one of the highest probabilities of a crash in the stock market looking out 60 days.
A stock market crash within 2 months? Real estate vacancies, defaults, bank runs? We're going to talk about all this today, and what I did is I did something really cool. I took my 3 favorite interviews from this previous week and I sliced out every single frame, every single second that you don't need to see, and what's left is a lot of information that's going to get you up to speed and tell you what's going on in the economy right now very quickly. My version's better though because it takes out a lot of stuff that you don't need to hear that's wasting your time. You're going to really like this one, I promise you. Stick with me, this one's going to be good.
You've been writing about this for a while and how these commercial landlords face the 1-2 punch of remote work, so office buildings are less occupied, and rising interest rates as well.
What's going to happen with real estate? What's going to happen with interest rates? Is there going to be contagion from all this bank fallout and bank collapses? We had the second largest bank failure ever recently, a couple days ago. Is this going to be a contagion? Let's hear what a lot of these on-media experts are talking about.
I mean, Larry, the last time we saw mortgage rates shoot up this way, we saw real demand destruction. People were walking away from their mortgages.
When interest rates go up, these bonds that are held and available for sale or held to maturity, the value of them go down. They're not immediately recorded as such.
And of course, the full interviews, all 3 of these full interviews you can get to from the link below in this description in this video if you want to see the whole interview. If you see something that you like what you're seeing, just click on that, see the entire interview so that you see it from the perspective it was actually originally published.
That is a broader phenomenon because that is not specific to Silicon Valley Bank.
Wow, 60 days? You're saying you're going to see it? We're going to see a crash in the stock market within 60 days?
Yes, because the withdrawal of capital from the middle class families is so spectacular.
By subscribing to the channel, showing your support, it allows us to bring more great videos just like this one to you. It really encourages the entire team.
And the other question just involves confidence. A variety of different, the underpinnings of the financial system fundamentally depends on confidence.
Nothing in this video should be considered as personalized trading advice for you. This channel is all about your economic survival, and you do need it much more right now than you ever have before.
So you're even in the market, you've been in the market for 2 years in these moronic FANG stocks that have gone nowhere, right? The most crowded trade on earth. You're flat to down after 2 years.
They're building buildings that Blackstone and other landlords own where the cost of monthly payments has gone up 300% in the last 12 months because of floating rate debt.
The bottom line is for every 1% increase in rates, and we've done almost 5% now, every 1% takes $50 billion out of the pockets of middle-class families.
I'm curious about the mechanism here of these default declarations, John.
Larry, before you get into what we're looking at in terms of rates and the impact, I want to bring Adam Johnson in here because he's on the other side of this trade. Adam, you're not expecting a recession.
No, I'm not expecting a recession. And my argument is the 2 E's of earnings and employment.
This is clearly a strategic decision that somebody in a boardroom is making. Why?
Auto loans right now are approaching 14%. Almost 20% of auto loans are $1,000 a month. And so the middle class families are getting hammered here. And so the consumer pressure is, violent. But on the high end, the wealthy are doing well with excess savings and higher interest rates.
But the situation that they face right now is, a situation that a bank just doesn't want to find itself in because of this concern. It comes back to that confidence. Once people start, this is the classic run on a bank. I mean, once people start pulling funds, no one wants to be the last person standing in the fund.
Employment's at an all-time high, and earnings, while not stunning, are better than feared, and revenues are actually rising 5%. Larry, I'm curious, you made the comment that there's some sort of pending crash coming up in 60 days. That's a pretty bold statement.
Days. That's what he's getting from his Lehman indicators. He talks to so many institutions every day. Go ahead.
But 60 days, Larry. Do you really believe that your indicators are right, and that there's some sort of crash when you have the most amount of people ever making the most amount of money ever, spending the most amount of money ever, and it's translating into earnings that, while not stellar, are enabling revenues to actually rise?
Go ahead, Larry.
In the case of CMBS, commercial mortgage-backed securities, you basically have to go into default to renegotiate the loan.
Well, remember, if you have $10 million in the stock market 2 years ago, you're flat. Okay, so there's a lot of people that have had money in the market for a long time. All these failed rallies, that's beating on the psychology of investors, number one.
When you have a mortgage like this that's bundled into all kinds of bonds and you have multiple owners, you can have parties who veto any agreement, and it's just a much more cumbersome and sort of legalistic administrative negotiating process.
Okay.
And the reason I take these interviews and I cut out all the stuff you don't need to see, because it allows you to see all the important, relevant information, nothing else, just that.
Number two, $10 million in cash today generates $510,000 a year in treasuries, in 1 year treasuries.
Wow.
Okay, think about that. A year ago, you're talking, this was $70,000. We have to do the math here, okay? Common sense.
Okay, thanks for explaining that. The thing, though, is that as more landlords default on specific loans, they actually regain some leverage in their negotiations. Is that right? So do they want this to happen to some extent?
I think over the next few days, going to see a process in which SVB will now try to either raise capital or potentially be sold, or there's likely to be there will at least be discussion of whether the federal government needs to step in even beyond the facilities that currently exist.
Well, there are definitely people who feel like, if Blackstone is doing this, and if PIMCO is doing this, and if Brookfield is doing this, maybe I should join them and start negotiating too.
What you're saying, Larry, if I'm hearing you right, I'll let you run with this, is that effectively the average investor is smart enough to recognize there's now a choice between stocks and bonds. So that average investor is going to say, I'm going to sell my stocks and I'm going to go buy bonds and just make 5%. Is that basically where you're getting the notion?
Yeah, that's exactly what he said.
Right?
There's real competition now to stocks. If I'm going to make $500,000 in fixed income, what the hell am I, dithering around in the stock market if, in fact, I'm worried about a profits recession? Is that right, Larry?
Let me ask you a question.
The latest economic data have come in stronger than expected. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
2s, 10s are 100 basis points inverted. So that means the 2-year treasury is 100 basis points more than 10s. That's threatening. But then on top of that, you look at the underperformance of the regional banks.
Because of its potential to raise concerns about what's happening in the portfolio of other banks and, how are they valuing their assets and, is there a broader confidence problem?
So your regional banks are your classic canary in the coal mine. They're underperforming the S&P by like 6, 7, 8% over the last 6, 9 months, a year. So the regional banks are telling you something really bad is happening under the surface in commercial real estate, auto loans, residential. There's really massive cracks under the surface, and that's why the market probably goes down 10, 20%, maybe 30% the next 60 days.
10, 20, 30% in the next 60 days.
For lenders, a lot of them are probably going like, I don't really want to own this property. If Blackstone can't make money on it, how am I going to make money on it?
If you look back at 2000, right, the biggest number in jobs right before the 2000 drawdown, 2001, the strongest number the previous year and a half was literally right before the market buckled.
I think the last time we spoke to you, John, we were talking about defaults, I think, in Los Angeles and maybe another one in New York.
When you have this January number that was so spectacular, it's gotten a lot of people excited about a soft landing. But if you look back the last 20, 30 years, when you have this seasonal adjustment in January, typically the February, when you have that spectacular kind of outperformance, which is seasonal.
Well, this specific portfolio has a 45% vacancy rate.
In that case, you want to be long gold miners and things that will benefit emerging market equities, things that will benefit from the Fed cutting rates.
Well, you say buy the gold miners in the stock market. Are there any other areas to hide within the stock market if, in fact, these predictions are right, that we're going to see a stock market crash within 60 days?
Generally what I've heard is more people have been going into the offices in Europe because they live in smaller homes. It's harder to work remotely than it is here in the U.S.
And when you went around the trading floor after the dot-com crash, the most popular investment was European global equities. But if you look at a chart of the global equities ex-US, okay, global equities ex-United States versus the NASDAQ or versus the S&P, you're breaking a multi-year down channel. You're talking about 10, 15 years of massive outperformance from the United States.
Well, I mean, look, okay. What you're saying is that U.S. stocks sell off and Europe doesn't. I have a hard time believing that. That, in fact, if the U.S. sells off, we get a stock market crash, the rest of the world doesn't follow.
Now, for the first time, you're seeing spectacular outperformance from global equities, MSCI ex-US, which we would say. That is where the outperformance is going to be.
It's always great to go back and take a look at what I said in the past and see how it turned out. In this video on screen right now, you click on that, you can see a few months ago how I said, or a number of months ago, I said that inflation and real estate are both going to be coming down while defaults and unemployment is going to climb. So let's see how I did from what I said a few months ago. With the exception of unemployment, we've been calling this spot on so far, and unemployment will be next.